Hi, I'm David.Muerle with Coldwell Banker Capital Gateway, and today I wanted to talk about 1031 exchanges. Now, you're probably aware of the fact that when you buy investment real estate, or when you buy tax or bonds, when you sell them, there's going to be a capital gains tax, and it's a lot of money. Currently, the federal capital gains tax is at 15%, and then for the state of California, we have an additional 9.3% added on top of that. So here's an example. If you purchase a house for $250,000 and now it's worth $600,000, you have a gain of $350,000, less any expenses you can write off against that gain. But on top of that, you've depreciated the property over the years, and that depreciation is also a taxable event. So this tax could amount to well in excess of $85,000 or even more. So that's a lot of money, but did you know that you can defer 100% of that tax just by doing a 1031 exchange into a replacement property? So here's how that works. When you sell your investment real estate, you must purchase like-kind property, and you must do it within certain time frames, and you must follow very specific rules. Now understand that this is a tax-deferred program. If you ever decided to get out of real estate altogether and liquidate those assets, at that time it would be a taxable event. So, but here's where a 1031 exchange really gets great. You just keep on exchanging into properties that have better and better cash flow throughout the years. And you do this right up to the time of your passing. And at the time of your passing, the base gets reset. It gets set to what the value is at the time of your passing. So all those capital gain taxes that you accumulated throughout the years are just completely wiped out. And your heirs, you've left an amazing legacy for your heirs, and they're set for life. So let's look at the nuts and bolts of how this works. Let's say you have a property that you purchased for $500,000, is now worth $1 million. Well, your first step is to get a qualified intermediary who's going to work as the middleman in this transaction. And it's really important that you understand that this person is not licensed. They're not regulated by the state. So it's up to you to do your research and make sure this person is really qualified. It's not time to bargain shop. It's time to get someone who's solid and going to take good care of you. My favorite way to find a qualified intermediary, or what's called a 1031 specialist, is to just go to your favorite title company. The typical title company in town owns a 1031 exchange a specialist, and I feel very comfortable going with those folks. And they also become a great source of wonderful advice too. So, and now that you've hired your 1031 exchange company, you have some very important time frames that you have to keep in mind. From the day that you sell your property, you've got 45 days to identify the properties that you're going to purchase. Now, the most common rule used for identifying properties is the 45-day rule. It is the 3-property rule, and they have to be identified within the first 45 days after you close escrow. But you don't have to close on all 3. You only have to close on 1, and you've got 180 days in which to close on that transaction. Now, it's really important that you understand that these timeframes are not negotiable with the IRS whatsoever. If you wait to the 46th day to identify your properties, you just ruined your exchange, and it becomes a taxable event. So, let's talk about how I like to do it. What I like to do is I like to not only just identify the properties that we want to exchange into, but actually get into escrow on them, do our inspections, and get our financing in place, and ideally even close escrow within the 45-day identifying period. The reason why I like doing this is because it eliminates the stress. It eliminates the risk of doing an exchange. Because if the transaction were to blow up at the end, you still have some days left to identify other properties that you could exchange into. So there is another rule for identifying properties. It's called the 200% rule. It means you can identify as many properties as you want. You're not limited to the 3 properties, but you can only identify up to 200% of the property, of the value of the property that you're exchanging out of. Then there's a third rule where you can identify as many properties as you want for as much value as you want, but you have to close escrow on 95% of the properties you identify. So you may have special circumstances where that makes sense for you. So how does it work? Well, when you sell your property, the money doesn't go into your bank account. It goes directly to the qualified intermediary. Any money you touch becomes taxable, so don't touch the money. Don't use it for anything. And then when you buy a property, it's just a regular escrow, and it's just funded by the qualified intermediary. So let's go over some very common questions. One real common question is the statute says you need to exchange for like-kind properties. Well, what is like-kind? Well, like-kind just really means real estate. You could have a condo that you want to exchange into a single-family residence, or a single-family residence you want to exchange into an office building, or an office building that you want to exchange into an industrial, or you want to exchange into raw land. As long as it's real estate, that's all that they mean by like-kind properties. Now, you may also be interested in selling your investment properties and exchanging into a primary residence. Well, that's not allowed. This is for investment property. So if you're buying a property and there's a possibility that you're going to convert it to a primary residence after close of escrow, make sure you rent it out for at least 2 years. The statute doesn't tell us a time frame, but most financial advisors tell us at least 2 years of renting it out so that you can show the IRS you had intention of having it an investment property. Another question I get is, well, what if I would just want to exchange my primary residence into another primary residence? Well, this isn't the medium for doing that, but you also already have tax benefits for primary residences. $250,000 of your gain is already wiped out by the $250,000 write-off for a single person, and $500,000 for a married person. So that's probably going to be better than an exchange for you anyway. Now, sometimes people want to do what's called a reverse exchange, whereas you buy a property and then you sell a property to fund that transaction. That can be done. It's called a reverse 1031 exchange. It's much more expensive to do and far more complicated, but it is out there. And another thing is boot on a loan that you want to avoid. If you sold a $600,000 piece of property that had a $200,000 loan, you still must replace the property with at least a $600,000 property, and that $200,000 portion that was a loan, you can replace that with seller financing. You can replace it with your own cash. You can replace it with another loan. But the key is you still have to buy, even though you only had $400,000 cash, you still have to buy a $600,000 property. If you only bought a $400,000 property, the $200,000 forgiven debt would be a taxable event. So there's your scoop on a 1031 exchange. It may not be the right medium for everyone, but it is the most common tool we use to defer taxes. So you can contact me with your questions. If I can't answer them, I'll refer you to a qualified expert who can answer them. And whether you live in California, as I do, or any state in the union, I can refer you to a realtor who specializes in 1031 exchanges so they can give you information on the exchanges that are specific to your community. That's the key to having success in this, is getting a local realtor who knows local values and has local knowledge. Thank you. My name is David.Muerle with Coldwell Banker Capital Gateway, and I look forward to helping you in your next transaction. Thank you.